Are you torn between investing in the S&P 500 or going all in for something like the QQQ with tech stocks? You are not alone. In this video, we're going to break down the ETF strategy, showing you in comparison the S&P 500 to the QQQ or the NASDAQ 100 and help you decide which one is best for your portfolio. Now make sure you like and subscribe to the channel. Stick around to the end. I'm going to tell you my portfolio and how I kind of break it down. So let's go ahead and get into this. Now, what is an ETF? An ETF is an exchange traded fund. It's a bundle of stocks or bonds. Like just a regular stock, you purchase one ETF, but you're buying a group of companies, which is like the S&P 500 and the NASDAQ 100. Now, why are these super popular? First one, they are very low cost. When it comes to the overall cost of an ETF, you're talking a 0.02, 0.04. It's not a percent, 2%. You're not paying those financial advisor fees, and there is diversification. For a majority of ETFs, they do have automatic built-in diversification, which we're going to look at with the S&P 500 fund, and of course, liquidity. When it comes to mutual funds, a little bit different with the exchange traded funds. Because of the liquidity, you can buy and sell during market hours, making a big difference. Now, some ETFs track specific indexes like the S&P 500 or the NASDAQ 100, while you can get them a lot more centralized or a lot more kind of pinholed into technology, healthcare, energy. There are so many ETFs that follow a very specific sector, or even something like semiconductors or tech companies themselves building out a lot of different ETFs. So thinking about the S&P 500, these are the 500 largest companies in the United States. This makes up roughly 80% of the entire stock market. When we look at some of the big names, you have Apple, Microsoft, JP Morgan, Procter & Gamble. These are some of the mega-sized companies, trillion-dollar companies that we see within the United States. And the top S&P 500 ETFs that we see for this, the VOO, the SPY, the IVV, there are a lot of ETFs from different companies that track the same indexes, but overall, they just have a little bit of change in the expenses. Make sure you're doing your research and figuring out which one is the best for you. So thinking about that S&P 500 ETF, it has broad market exposure, historical growth rate, very low volatility, and with the ETFs, like we said, it is a very low fee. Now, the big con for this, slow growth. You are only getting the market, and there is no sector-specific ETF that is built into this. You are buying the 500 largest companies, which offers large diversification, but they are mostly large companies. There is going to be no exposure to mid-cap, no exposure to small cap, with an ETF like the S&P 500. On the other side, when we look at very heavy tech-focused ETFs, they are very high growth companies and really driving innovation. When we start thinking of artificial intelligence, when you start thinking of semiconductors, when you think of the massive computing, that is what exactly the tech-focused ETFs are. Now, popular for these, QQQ, which is the NASDAQ 100, it is heavy into tech. You can also look at the ARKK or the ARK Innovation Fund, which is actively managed, a little bit more of a fee, but I do hold this in the portfolio that ChatGPT actually built for me, and the XLK, which is the S&P tech sector. Now, of course, with this, you have a much higher upside, higher growth potential overall when you start focusing in techs, exposure to cutting edge trends, and of course, more exposure, like we said, to volatility. That is the biggest con. When you think of the market going down, even looking at 2022, we've seen almost a 30% decline when it came to these heavy tech ETFs, more sensitive to rate hikes, more sensitive to rate corrections and market corrections, and they have less of a diversification, which could be good or bad depending on exactly how old you are. So let's take a look and kind of break down the comparison of these two. So let's hop over and take a look. So here we have the comparison of the VOO and the QQQ. And overall, like I said, one is focused on the S&P 500, one is focused on the NASDAQ 100, which is the big difference. Now you look, when we talk about diversification with the VOO, holdings are 507 with the VOO because you are holding roughly 500 of the largest companies within the United States. Then on the QQQ, there is only 102. This does track the NASDAQ 100, so they are two different indexes that they actually follow when you start looking at the difference between the S&P 500 and looking at the difference between the NASDAQ 100. Now, when it comes to performance, this is the interesting part because Everybody thinks that, the NASDAQ, the tech is really driving everything. We are going to see a much higher return out of that, which you can see there are a lot of times where the VOO has kind of outperformed the QQQ. Those are some of the markets, those are some of the pullbacks. And when we start looking further and thinking of the growth itself, when we start looking at the runway for investing 1 month, 3 month, even looking at year to date, you can see the QQQ has been doing exceptional. We have seen a big driving force when it comes to the ability to really push those large tech companies and being able to carry the market. 1 year, you can see we got about a 3% difference, but then we get into the 3 year. This is where it gets a little more interesting with something like the QQQ, because now we're talking about 5.5% difference, the difference over an extended amount of time. And then we look at the 5 year, which is about 1.4% difference. So they are kind of catching up. Now, of course, the big thing with this is how can you take when a market is down? If you're sitting there and you watch something like the QQQ drop 30% in market value, where roughly the VOO, I believe, fell about 18% at that time, it would have been a lot better and a lot more really indicative to be in the VOO versus the QQQ. But you can see having a diversified portfolio and having, not having full exposure to one or the other really does make a big difference. Now, like we said with index funds, a 0.03 versus a 0.20, QQQ, a little bit more expensive, but overall, when it comes to the value and what we're seeing with the growth, it does make a lot of sense when you look at what is in here. Even looking at the average volume, I mean, $3 billion, $22 billion. These are two huge funds. And you'll notice based on size, their comparison is almost broke up identically, except in that QQQ, there is going to be a higher percentage based on those tech stocks. And also note that in the VOO, you are not going to see, or excuse me, in the VOO, you are going to have all of the sectors. You're going to have the diversification, 500 plus companies in there, and you are also going to have the financial side. Now, that is one thing to note with the QQQ. It does not include any of the financial companies within the S&P 500. So a little bit, again, kind of based on diversification when it comes to really building that out and seeing the difference between both of those. Now, which one is right with you? For this, the answer is comes down to your goals, what your risk tolerance is, what kind of level of tolerance you would really have. So some questions to ask yourself: do I want steady growth or do you want higher growth? Could you handle a really big dip if it comes in the future? Are you investing for the long term or more of a shorter? So simple strategies, and really the basic way to do this, if you're conservative, if you don't want to risk anything, if you don't want the big ups and downs, I would absolutely go into that S&P 500 ETF, whether it be the VOO, the SPY, being very conservative, wanting to have the exposure to the S&P 500 and to all of the sectors in the market. Conservative strategy would be absolutely going in again, all in for that S&P 500 fund. Now, if you're looking at a balanced fund, we're looking around 70% in the S&P, 30% in tech, which does give you exposure to the QQQ, exposure to the NASDAQ 100, and a lot more runway for growth. Now, if we're thinking an aggressive portfolio, you could actually go in there 50-50, putting 50% into that S&P 500, putting 50% into something like the QQQ. And again, when it comes to your foundation, when it comes to those growth ETFs, you could go in and build a really solid portfolio that has a ton of diversification by simply buying 2 ETFs. Now, my thought in my strategy that I had in this, right now, I do have a strategy where I have roughly 45 to 50% into the QQQ. So I do have more of an aggressive portfolio and then a smaller relationship in there actually with that S&P 500. And then we also do hold 15% in the SCHD. And overall, that is a little bit, and I keep kind of reducing what I'm holding within that income generating fund because it has been underperforming for an extended amount of time, which I might actually have to drop it out of the portfolio to add more into that VOO and add more into the QQQ and just keep the SCHD out of it until getting ready for retirement. So now for rebalancing, I do not rebalance the portfolio. If you guys are familiar with M1 Finance, I have some links down below. When you're making contributions, and I do this every single Monday with dollar cost averaging, but when we're making contributions in there, we are investing over time, and it is broken up into percentages, meaning that if the QQQ is overperforming or is growing faster percentage wise to what's in the portfolio, my contributions are going to go into a different section of the portfolio, meaning that I don't have to rebalance. I don't have to buy and sell in the portfolio. My contributions on a weekly basis through dollar cost averaging is actually going to average it out over time. So guys, that is going to do it for today's video. But if you found this video helpful, definitely give it a like, subscribe to the channel. Let me know in the comments what you guys think. Do you invest in the S&P 500? Do you invest in the heavy tech side like the QQQ? And of course, with all the investing videos, trying to save you money, trying to set you and get you to that debt-free journey. So until next time, stay invested and stay focused on the journey.